The U.S. economy is facing a make-or-break moment.
Our country's becoming very rich.
And look, the government says inflation is 2.4%. The money supply is growing at almost 5%. One of those numbers is a lie. And if it's the one I think it is, then the most popular inflation hedges out there, they're not protecting you from anything. So I studied the 4 major inflation hedges available to the average Joe in order to find out which one actually protects your money. 3 of the most popular are flat out failing right now. And the one that is actually working isn't what you think it is. Let's start with the one that literally has inflation protection in its name. Treasury Inflation Protected Securities, TIPS. Your payout adjusts with the Consumer Price Index. So as inflation goes up, you're supposed to get paid more. The government built you a hedge. Sounds incredibly responsible, doesn't it? Like wearing floaties in the shallow end. Here's the problem. TIPS adjust to CPI. And CPI doesn't measure real inflation. And I'll explain what I mean there in just a minute, but the point here is you're getting inflation protection based on a number the government controls. They're grading their own homework. And this isn't theory. In 2022, when inflation hit multi-decade highs, the highest in 40 years, TIPS posted negative total returns. The thing literally named inflation protected lost money during the worst inflation most of us have ever seen. How is that possible? Because TIPS are still bonds. When interest rates rise, bond prices fall. And that drop overwhelmed the inflation adjustment. So Matt, what you're saying is the government causes the inflation by printing money. They measure it with a number they control. They sell you a product that protects you based on that number. And when inflation was at its worst in 40 years, that product lost money? Yes, that's exactly what I'm saying. And let me show you exactly how they're doing it. And this is all public, by the way. Go to the Federal Reserve's website. End of 2025, the Fed's balance sheet was $6.155 trillion. March of 2026, $6.271 trillion. That's $75 billion printed in 90 days. $25 billion a month. And that's before things get worse. What do they do with that money? Well, they buy treasury bills and bonds, lending money to the government that will never be paid back. It won't be paid back because fewer countries and institutions want to lend money to the US government. And they can't raise interest rates to attract buyers because they're sitting on $39 trillion in debt. So the government says, hey, want to lend us money at 3%? And the world says no. So instead of raising the rate, they have the Fed print money and buy it themselves. They're literally lending themselves imaginary money to cover real debt. It's insane, isn't it? Now, here's where it all connects. The government says inflation is 2.4%. That's the CPI number. But CPI doesn't measure price inflation. I told you I was going to get to this. It measures the cost of living, which is a completely different thing. So if steak goes from, say, $100 to $110, real inflation is 10%. But CPI says, hey, just buy the chicken instead for $102.40. So inflation is really only 2.4%. Or they just remove the meat from the calculation entirely. Vegetables only this month. Meanwhile, the M2 money supply grew at 4.9% in February. That's the real number. And your TIPS are pegged to 2.4%. That's not a hedge. That's a participation trophy. And everything I just showed you, that's before the next round of bailouts. Private credit, commercial real estate, banks holding underwater treasuries, they all need help right now. Where does that help come from? More printing. Now bonds. I'm not going to spend a lot of time here because bonds are just TIPS without the pretense. Your bonds yield 4.3%. Real inflation is running 5 to 10%. So you're losing purchasing power every day with them. You're buying an IOU from a borrower who is actively counterfeiting the currency they'll repay you in. Bonds have high liquidity though. You can sell them at any time. But bragging about bond liquidity right now is like bragging you can evacuate the Titanic in record time. You made it off the boat to only freeze in the ocean and die. Now, everybody's favorite go-to when it comes to beating inflation, gold, the asset heavily promoted by men who own at least 3 different types of tactical shovels. And look, I'm not going to sit here and pretend it isn't working. Gold returned roughly 65% over the past year, nearly 4 times stocks, 8 times bonds. It crossed $5,000 an ounce this year. It hit an all-time high of $5,595 in January. Central banks, they're hoarding it at record pace. Gold can't be printed. The Fed can't create more of it. It's the anti-dollar. But gold dropped 27% in 6 weeks. from $55.95 in January to $4,090 in mid-March. If you needed that money during those 6 weeks, you got crushed. Gold doesn't produce income. It doesn't mail you a check. You have to buy every ounce with your own money. Gold is a preserver, not a builder. It has a crucial role to play, and we're coming back to that in a minute, but alone, gold is a shield with no sword. Now, real estate. It's getting crushed right now. I mean, if you're reading the headlines, sales are down significantly, all-time lows in some places, but prices are not. Nationally, prices are still expected to grow 1% to 2% this year. If so, though, how is that a hedge, 2%? Well, if all you're measuring is the 2% number, you're licking the frosting and throwing out the cake. Real estate isn't one hedge. It's 5 layers of protection stacked on top of each other, the financial equivalent of a 5-layer bean dip of invincibility. Stay with me. Layer 1, appreciation. Houses go up in value over time. Even in a slow year like this one, prices are expected to grow 1% to 2%. On a $400,000 house, that's $4,000 to $8,000 in value that you gain by just owning it. Not exciting by itself, but that's only layer 1. Let's keep going. Layer 2, leverage. Most people don't pay cash for a house. They put 20% down. So on that same $400,000 house, you put in $80,000 of your own money. The house goes up 2%. That's $8,000. But you didn't invest $400,000, you invested $80,000. So that $8,000 gain on $80,000 invested is a 10% return. What looks like 2% in the headlines is actually 10% in your bank account. Same house, same appreciation, completely different return because of leverage. Layer 3, fixed rate debt. Now this one has nothing to do with the house going up in value. This is about what you owe going down in real terms. Your mortgage payment, it's frozen in time. The Fed prints $25 billion a month, and every dollar they print makes the dollars you owe cheaper. You locked in your payment at today's dollars, but you're paying it back with tomorrow's weaker dollars. You're paying back expensive debt with cheap money. That's a really good trade. Layer 4, income. A rental property sends you a check every month. Well, your tenant does. You take that income and pay the mortgage. So indirectly, your tenant is buying the property for you. If we're talking gold, that's your cash that buys it. Tips, your cash. Bonds, your cash. Rental property, your tenant goes to work, earns a paycheck, and hands you a portion of their cash so you can pay down your principal. And each year, that check from your tenant gets bigger because of inflation. Rents jumped 25% to 40% between 2019 and 23. Your mortgage stayed the same. It didn't move. That growing spread is positive cash flow created entirely by inflation working for you instead of against you. Now, layer 5, the tax fortress. Real estate is the most favored asset in the tax code for the average person. The IRS lets you depreciate the building even while the property is appreciating. And when you own an income property, you're a small business in the eyes of the IRS. That puts you in an entirely different category when it comes to how you get taxed. As an employee, you make money. The IRS takes theirs, you pay your bills, and you get your share last. As a business owner, you make money, you pay your bills, you take yours, and you give the IRS theirs last. And if that sounds like semantics, do the math, because that change, that small little change in sequence, creates an entirely different bottom line. Now, add all 5 layers of that bean dip together, and it's not difficult to get to a 20 to 25% annual return. Real estate doesn't just keep up with inflation, it front runs it. And if you disagree with that, you just don't know how money works. That's okay though, I mean, most people don't. I mean, I didn't for a very long time. Trying to fight inflation with traditional Dave Ramsey style advice, it's like swimming against the current. Regardless of how good of a swimmer you are, you will tire out and the current will win. Now, if that makes sense to you, and you'd rather use the current, inflation, to your advantage, here's what that looks like. Use fixed rate, long-term debt to buy income property. That alone puts you on the right side of the system, but it's still an incomplete plan. It's better than nothing, but it's incomplete. And here's why. Inflation has a built-in lag, a lag between costs and incomes. For example, when inflation rips, costs rise immediately. Insurance goes up, property taxes, maintenance, groceries rise, but salaries take time to catch up. Rents take time to catch up. I mean, lease renewals happen once a year. Tenants push back. Real estate can be temporarily illiquid during this lag too. There's a 6 to 18 month window where inflation is hurting you before values and incomes adjust. This is where gold earns its spot, not as your primary hedge, as the bodyguard that keeps your real estate machine running during the lag. Gold reacts to inflation in real time, no lag, at least not compared to rent adjustments. So while your rents are catching up, your gold position is appreciating fast enough to bridge the gap if you need it. So you want to hold enough gold to cover 6 to 12 months of mortgage payments. And if you do that, you might not feel the lag at all. And actually, you could find yourself coming out on the other end much better off after the inflation, just like the wealthiest in our society. That's a big clue. Actually, it's evidence. I mean, if you've ever wondered how the rich get richer and the poor get poorer, now you know. But here's what nobody is talking about. And they might be very soon, we don't know. But what if inflation takes off so fast that the dollar essentially collapses? I mean, maybe over just a few months, maybe overnight. The good news? Your debt collapses too. The bad news? You could still lose your house if you don't have enough of those collapsed dollars to keep making payments. Your leveraged property, the one your tenant has been paying off for you, that could be at risk also. But if you had a stash of gold, I mean, imagine this. What takes 10 ounces today to pay off your mortgage could take just 1 or 2 ounces after the dollar collapses. Under those circumstances, society is in chaos and total crisis mode. And there you are with a free and clear house and 8 ounces of gold left over. Gold isn't just a hedge. It's an insurance policy that you don't lose your shelter and that you don't lose the shelter your tenants are renting from you either. That's what active defense looks like. You've secured your home. But there'll be more to deal with amid such chaos. You'll want to protect everything else you've got too. And that's why I pulled this one out here for you to watch next. It's all about how to hide your 7 most prized assets during a financial crisis. And it's pretty simple too. I mean, you can hide them in plain sight and no one can even touch them. So watch this next. God loves you and so do I. Take care.